Hello guys, it's CastAwayTrader and welcome back to my YouTube channel. Today's video is called Can S&P Rally When You Feel So Scared? I'm not gonna talk about scary news we are getting from Europe or New York. The problem is you cannot reliably forecast news, but even bigger problem is even if you nail the news, it's almost impossible to make a correct prediction about how market will interpret those news. Would a really good news be enough for market to rally, or market could say those news were expected to be better and that's why I'm gonna tank? I am working on Harmonic Elliott Wave theory. I'm applying it and this is my only tool. And I try not to pay much attention to news because what news do, they distract us from what really matters. And what really matters in trading and in the stock market is fractal analysis and fractal forecasting. So I suggest that we focus on price structures, and we will be talking about price structures in this video. And because when we focus on price structures, the price starts talking to us without any interpreter. We will start to understand what could happen next solely based on price structure analysis. Let's start. Before we start, I want you to read that important disclaimer. Very important to understand that past results are not indicative of future profits. This is how my website looks like. You can find it at www.CastAwayTrader.com. And that was my last video I posted last Sunday on March 22nd, 2020. It was called How Deep the Stock Market May Dive. So I want to start that new video from coming back to the old video and discuss what has happened since then, where we stopped and what happened over the last week. So my previous video, when it was recorded and published, we were here. So I was looking at that fractal flat microstructure. It's a corrective structure, and this is the top made in February 2020. Of the top, I was expecting to get ABC down. And my idea was that first ABC down would not be the full wave 4, but only the first leg down in subwave A, parenthesis A. Of that low, I expected to get a quick and probably strong pullback, that cat bounce as many people call it, in corrective wave B up, which could retrace up to 50% of the whole drop we saw from the top made in February 2020. So we are here, and at that point, at the moment when I recorded the previous video a week ago, I expected the final A down, B up, C down structure, which would complete it and which would set the stage for such a strong recovery, a pullback, structured as ABC and in a corrective wave parenthesis B up. So let me show you that was wave A down, that was corrective B up, and subwave and wave C down was supposed to have an impulsive structure, meaning that we were supposed to count 5 microwaves inside that wave C. And this is where we stopped in the last video. We got 1 down, 2 up, ABC of 3, ABC of 4, and of that top around 2700 made on March 15th, we were supposed to get A down, B up, and C down. This is the chart I posted for my subscribers back then, and that was a theoretical path a price may follow to complete that structure. Again, we were talking about the first leg down in wave A of 4 of the top made in February 2020. I explained to my subscribers on Sunday at 6:16 p.m. that what we should expect is the first push down in subwave A, which would normally is unable to break under the low made by wave 3. Then we should get some corrective whipsaw structured as A, B, C, and that would be a corrective subwave B up, followed by the final push down with an impulsive structure in subwave C of microwave 5. Remember, the second leg down in subwave C has to have 5 microwaves inside. 1, 2, 3, 4, and 5. So this is Monday, March 16th, posted at 10:02 a.m. We got that first drop down. Yes, it violated a little bit the previous low made by wave 3, but as normally, it was unable to sustainably break under that low. So from that point, I expected a corrective ABC up and that corrective subwave B up to be followed by the final decline in subwave C of wave 5. We got that subwave B down, we are retesting the low again. Now we have a triple bottom, and many traders believe that triple bottom basically becomes a great foundation for a rally, but normally that triple bottom is only a temporary bottom. So my expectation was that we would get push higher in subwave C of wave B up, followed by another push lower in the very final C of 5. And this is what we got. That was the first drop in A of 5. We got a little bit lower low, and immediately it rebounded, but that B up has to be itself subdivided into ABC. A up, B down, C up, and here I'm adding the red target box based on extensions of that first recovery of that low. My base assumption is that it will stop either at 100% or 123.6% extension of the first recovery of the low. Again, I'm adding here, my comment is that I maintain bearish bias. We cannot call the bottom until I get a fully completed structure. What I meant is that at that point, this is our main point of reference. This is the top of wave 4, which made a lower high in comparison to previous highs, and to complete the structure, they need to get the final A down, B up, C down. This is the model of the final decline. This is wave 5. This is how every single wave 5 down normally behaves. We get first leg down in A of 5, a corrective look in B of 5, and the final impulsive drop in C of 5. So this is our actual structure. We got A down, ABC of B up, and that C down, because it has to have an impulsive structure. Here I'm adding a theoretical trajectory for the decline in the very final C of 5. We should always get 1 down, 2 up, wave 3, the strongest part of the drop, corrective 4, and the final push down in wave 5. This is how it looks in the model. Those are 5 microwaves inside the second leg down in C of 5. And this is the actual chart. We got 1 down, 2 up, and this is the strongest part of the drop in microwave 3 down. This is Tuesday, March 17th, posted at 9:44 p.m. Finally, another push down, and here we got enough drop to call it a completed wave 3. So from this point we can expect a corrective wave 4 to be followed by another push down in the very final microwave 5. Again, I maintained my expectation that we needed the final micro push down to 23.25 in the microwave 5 down, posted in the morning at 9:37 a.m. Again, this is the model. I want you to understand that this is what I do. I use those models, a limited number of models, and this is what I teach you how to use those models, and I find similarities between the model and the actual chart. And once I find similarity, I start expecting the move under the model and extrapolate it to the actual chart. So this is that easy. So if we are here, then we should get ABC up in 4 followed by ABC down, making a lower low. Let's see, we got that A up, B down, C up, and this is our wave 4. Look, it has made much lower high than the previous high made by another corrective wave 2 up, preceding corrective wave. This is what I wrote to my subscribers at 10:12 a.m. that pullback up could be a microwave 4 up. That means we need to get another push down in the very final microwave 5, and that 5 was supposed to complete the whole ABC down structure that started off the top made in February 2020. We are here, this is our model. We are expecting ABC down, we get A down, again you see it retested the low made by microwave 3, we got micro ABC up, that BO5 makes lower high in comparison to the previous corrective wave 4 up, and we are left with the very final push down, Wednesday 12:21 p.m. We are expecting the final push down here. This is it, that would be the final push down. It started 12:56 p.m. We are still expecting it to stretch lower. Boom! 1:44 p.m. it has stacked the green target box. At this point we are not sure whether it has bottomed or not, because you see, in theory it could have dropped once again deeper into the green target box. And this is exactly what happened. 3:50, the end of the day. Look, we got 1, 2, 3, 4, and 5, because in any ABC structure, the final subwave C normally has a clean, impulsive structure, internal structure, where we are able to count 5 microwaves inside. So we got a very clean ABC down in microwave 5, and together 1, 2, 3, 4, and 5. That was a perfect completion of the corrective structure. This is what I wrote actually, perfect completed microstructure of wave C of 5 down. What that meant is that at that point I expected that we gonna get a strong bounce of that low. Again, that was Wednesday 3:50 p.m. and this was a completion of wave 5 down. And the same day at 9:45 p.m. I posted for my subscribers that theoretical pass. So I expected to get first move up of the low, and you see how strong it was. It rallied for more than 100 points, followed by another decline which would retest the lows, not like retest, but which would make a little bit higher low, completing inverse head and shoulders pattern. That would be left shoulder, head, right shoulder, and that would be a launch pad for a new rally. So I expected that the second push higher would target around 25.30, but again it would be followed by another ABC down, and only then we would get the strongest part of the rally in the final subwave C, which would complete that whole pullback. And look what happened. After we got that first push higher, we got a very deep decline, and frankly it looked scared, and many subscribers in my chat decided that we're gonna break down. But after I spent some time with the chart, I concluded that I still think that this drop is a corrective wave B down, and I maintained my bullish bias, and I added my red target box. I said, so basically we need to get to that red target box, and this is what happened. This is the drop, and we got to 2500. But the problem was that the way how we got to that fractal did not look right. What I mean is that that structure, I call that type of a structure ugly structure, overlapping structure. Look at that structure. We got A up, B down, C up. So once that move up broke over the top, the previous top, it came back down, retested it, and never came back again. So it kept moving higher. But look at this one. So we make first move up, followed by a corrective pullback. Then we go over, we go under again, go over, going under again, going over, going under again. That just does not look impulsive. That looks corrective. That looks like bulls did not have enough power to keep moving price higher. And this is where I concluded that I just do not like that structure. I do not see it as a promising start of another move higher. And we can count this structure as a double 3 structure. So double 3 structure is labeled as W, X, Y, where waves W and Y are composed of ABC structures. You see ABC up, ABC up, and even ZA was subdivided into ABC. When you get too many ABCs, you start thinking about a corrective nature of that move. So I said that, look, it does not look bullish at all. To become bullish, I need to get another ABC down, and that ABC down could actually retest those lows. And I was at that point, I was thinking that we got that major move down and we got that major bottom here. We got ABC of that bottom, and now we could get ABC down retesting that low, but we could still get a stronger rally afterwards. And I said that if ES drops lower than 20-20-40, the probability of that bullish setup will significantly get lower. Okay, and this is what we got. That was Friday, the end of Friday, 3:55 p.m. This is the bottom, which I considered as a major bottom. We got a WXY structure of that bottom, and after we got that double 3 corrective structure, it topped on Friday. We got another ABC down, exactly what I expected. I said I need to get ABC down, I needed to retest the low, and from this point we could get wave C up. Look, this is A, B, C, and that C could go over 25.50. This is 3:55 p.m. I am bullish at this point. By 5 p.m. I become not that bullish, because after close, ES sunk again by 25 more points. But even at that point, that structure was perfectly valid. Yes, B down managed to make a lower low under the previous major low, but we have so-called the expanded flat structure. And under the expanded flat structure, a corrective wave B could get bigger than the preceding wave A up. If it goes slightly under the major bottom, it could still deliver a major rally in wave C up. And the problem, as you know, it did not materialize. I mean, on Sunday night, we got another gap down, and that gap down essentially invalidated that bullish count. So once it happens, and it happens from time to time with all analysts, the first thing what you should do is to find an alternative count which would better explain what has just happened. And I do not think my count needs major change. Again, we are working with the very same wave C down. In the very same way, we need 5 waves down, and we still have 1 down, 2 up, ABC of 3, wave 4. This is where the previous video was recorded. Since then, we got a perfect A down, retested the low, very ugly corrective looking B up, perfect B up, And this is our major reference point. This is the top which was not violated by the next pullback up, and of that top we are supposed to get subwave C of wave 5 down, and that subwave C of wave 5 down is supposed to have an impulsive structure. Once we made lower low here on Wednesday, it was a good candidate to be a completion point of subwave C of 5, and we nailed that bottom and we got two nice rallies of the top. But as I've shown you on Friday morning, I concluded that that part of the structure did not look right, did not look like start of A, B, C up structure, and once we broke down, we got to the point where we had to find a new count, and this is my new count. I think that we are still in the very final subwave C of wave 5 down. We have to get 5 wave down, micro 5 waves down of that point. If it was 1, if it was 2, that could be 3 down. Then the pullback we got on Monday morning was 4 up, and now we need to get the final micro A down, B up, and C down. Let's zoom in. This is where the previous video was recorded. This is the reference point made by corrective subwave B up, and this is where we need to get the final 5 microwaves. 1 down, 2 up, 3 down, 4, A, B, C. What is important is that we could put a major resistance at the top made on Monday morning. So if price manages to get over that resistance, then again we need to change the count, then again we need to but that would basically mean that most likely we would not get a lower low, but as long as price holds under the top made on Friday morning, I would stick to that count. So if we get that B up topped on Monday night, then we would be left with the very final push down. And we could use several tools which would help us to find a potential completion point for that very final subwave C of wave 5. First of all, we use projections of subwave A, and we projected from the top of subwave B up. We can focus on 123.6% extension that returns 2117 or 176.4% extension, and that returns 1935. In addition to that, we can measure that wave 3 down. We focused it from the top of wave 4, and we use two main levels, 76.4, 85.4 extensions. Those two levels are normal, both comprise the normal target box for the very final wave 5 down. And again, that was the top of wave 4. We are expecting A, B, C of wave 5 down. So those two levels give us two levels, 2130, 20060. Finally, because we deal with another wave 4 of lower degree and we expect the final ABC down, we could use the very same principle to that subwave A down projected from the top of B up, and that could give us another two levels, 2106, 20057, 1950. At this point, we cannot confidently say which one of those three levels would finally stop the drop, but because we know that that final C of 5, the wave C of 5, has to have 5 microwaves, we would be counting 5 microwaves on the wave down, and that would tremendously help us to pinpoint the exact termination point of that move down. And once we get that wave 5 down, that would complete the whole ABC down structure that started off the top of February 2020. I'm saying that we need to get that final move down here to complete that wave 5 down. I have 2 video courses, and now when many of you got stuck at home, you work from home, and I think more and more people would get stuck at home, you can start learning the Harmonic Elliott Wave theory, which is a better version of the classic Elliott Wave theory. I have 2 video courses. I strongly recommend you to start from the introductory video course. You do not need to know anything about wave theory, because that video course would give you all the basics, will show you all the rules, plenty of examples. It will be the foundation of your Elliott Wave mastery. The second course is called How to Trade Like a Pro. It uses the first course as your foundation, and it gives you more details. It shows you a lot of new small rules and details I personally found by trading Elliott Wave theory, modified Elliott Wave theory. And I strongly recommend you to take both courses, and both courses are on sale now, as you can see, and you can find links to those courses. They are posted on Udemy educational platform, which is the largest educational platform in the world. Go to www.CastAwayTrader.com/education. You will find all those links in description of this video. And this is a bonus. This is a bonus part of that video lesson. Very cool stuff. In my premium chart, we keep posting a proprietary sentiment indicator. This is the only proprietary stuff I have, and this is not my indicator, and I committed not to disclose the way how it is calculated. But in general, it's a pure math formula which takes into consideration VIX, which shows volatility of the market, and total put-call ratio. So we calculate that sentiment index every single day. And what's interesting is that last time we got that sentiment index hitting 0 was in November 2008. That was that specific spot, and this is when it happened. It happened on November 20, 2009. This is the sentiment index. 2 days in a row it hit 0, and this is when S&P 500 hit 752. What's really interesting is that 2 weeks later S&P 500 bounced to 910. Just in 2 weeks, you see, from 952 to 910, and Nasdaq bounced from 1316 to 1572. And you can see that VIX was 80 at that point, and it actually declined to 58. But what is really interesting is that it was not the bottom in the market. So 3 months later, in mid-March 2009, S&P dropped down again and made a lower low. But what is really interesting is that the sentiment index did not make to 0 again, so it made a higher low. That was a nice positive divergence between the price and that proprietary sentiment index. I'm telling you that because the sentiment index hit 0 early this week. Last week we closed 0 on Friday, and today on Monday we got 0.2, so it managed to stand up and get up of the floor. So it's very encouraging sign of a coming pullback in the market. But what I want you to understand is that because the drop down made sentiment index to show 0, it does not mean that was the bottom in price. So what I expect is to get some bounce, which could be a strong bounce. We could even retrace 50% of the whole decline of the top made in February. But I think it's inevitable that after that bounce, the market would continue moving down, and most likely we would make a new lower low. The second bonus stuff I'm gonna show you is the long-term monthly chart of Russell. And what's really important here on the chart is that you can see the critical support at 943.10, and as long as we hold over that support, we still have a setup for a new rally which would be able to make a new higher high in the very final wave 5. But in case Russell violates that critical support level, we could only expect a corrective bounce here and then another decline lower. So that would essentially mean that the top made in August 2018 would be a major multi-year top for Russell. As long as we hold over that support, we can count the top as the top of wave 3 up, followed by a corrective ABC down structure in wave 4 down. And we still could get wave 5 up, which could structure as ABC. But it's very, very important that Russell holds over that level. If it violates that level, even with a spike, that would significantly diminish the chance for a new rally in the very final wave 5 up, targeting a new all-time high. This is how my website looks like. You can start 15-day trial either for $39.99 or for $49.99 because I have two different plans. I have a premium trading chart and market focus posted on my website. This is the standard plan where you can get updates. You normally get alerts by email when I post a new update. You click the link, you go to the chart, to the special section protected by password, and you get a chart with my comments. So all those charts and comments I showed you in this video were posted on my website for subscribers. You can check details about that plan at my website www.CastAwayTrader.com subscription rates. Again, I will post that link in description to this video. And much better plan would be premium chat room, because not only you would get the very same access to the website and email alerts, you would be able to participate in the premium chat where I post more charts, I post updates more frequently, I add more comments, people ask me questions, I come back to them with my comments. And in my opinion, it's just better. It just delivers 3 times more value, and the difference in price is not that big. I strongly recommend you to consider that specific subscription plan. Thank you very much for your time. Subscribe to my YouTube channel, very important to me. Every video takes a lot of time. I steal it from my family. I didn't have lunch today, didn't have dinner today, because it just took a lot of time to combine together all those slides and just to go through all of them to understand what I'm going to tell you. It's not like, you know, I just turn on computer and start talking. It takes time. It takes a lot of energy. I would really appreciate if you could like this video. That would encourage me to record more videos. Thanks again, and let's hope that that fear would go away soon. Take care. I hope we will go through that difficult time. Thank you.